In this video, I'm going to show you how to raise funding from investors, and not just any investor, the right investors starting on day one. This is even before you've built anything, any MVP, any type of product. And this is a secret hack that I've learned after raising funding for 7 startups with 2 exits and over $100 million from my startups, other people's startups, as well as startup funds. And you're going to do this as the Chief Funding Execution Officer. And there are resources that I'm going to provide for you. And you're going to be able to look at how I do an idea validation pitch deck. And that's what it looks like. It's 9 slides. It's super simple to start fundraising from day one. And you'll also talk to prospective customers, which is another great benefit and advantage to this. I'm also going to show you this handy little chart where you can understand what needs to go into your pitch decks and is your startup fundable depending on which type of investor that you are talking to. Before we continue, my name is Ed Kang. If we met before, welcome back to my channel. Thanks for stopping by again. Use the chapter markers to jump ahead right to the good part of the video. As always, trying to make your life a little bit easier. If we haven't met, like I said, I've raised funding for 7 startups. I've had 2 exits. And that's just a fancy way of saying I failed a bunch of times to your benefit. And that's why I have this YouTube channel and videos like this to try and help you avoid some of the catastrophic mistakes that I've made during my startup career. Not to say you're not going to make mistakes, but I'm going to try to make your life a little bit easier because it's tough enough as it is. And that's why I created this tool called Chief Funding Execution Officer, which I also teach at startups.com, where I'm the Chief Strategy Officer over there. If you're from startups.com, thank you so much for being part of the community. If not, go check us out. A lot of free resources there. And while everybody's here, do the YouTube thing, like, comment, subscribe. Always appreciate your feedback. I'd love to know what you're thinking. Let's jump into how to raise funding from the right investors on day one as the Chief Funding Execution Officer. Checking in with our CFXO roadmap, you are right here. We are on step 1, and that has to do with founder funding fit. And if you're wondering how to get access to this, just check the channel description. I put it in the comments as well. Download the free resources and you can follow along. Let's talk about why you want to create an idea validation pitch deck before building an MVP. It's not your full funding pitch deck. It's sort of the baby light version of your pitch deck. And you can do this, and you should do this before building your MVP, before building anything, because you want to get as much validation and discovery as possible. You want to validate your idea, and you'll also discover your customers, because quite often founders build their startup and they don't know who to sell to because they're not, one, validating the idea, but also don't know who to go talk to. And that's what customer discovery is all about. And this idea validation pitch deck is going to take care of that for you. Next, you'll get practice and feedback. Founders are rarely good. In fact, they're pretty terrible at pitching their startup right from the jump. And you should get practice, because you'd rather get practice at this stage than fumble the ball when you're actually talking to real investors. And also, you want to get feedback from people right away, right in the beginning. Just like when you're building an MVP, you want to get that customer feedback so you can iterate and you got that continual improvement cycle. It's the same thing with your pitch deck. Think of your idea validation pitch deck as an MVP for what you're going to be pitching and how you're going to be pitching that, and you want feedback right away. Next, you're going to build your network for updates. Founders rarely start off with a warm market unless you've got the pedigree, which is the top 1% of founders. You've already raised VC, you've exited, you know everybody. That typically doesn't happen. It didn't start like that for me. So trying to turn on your network and suddenly meet all the perfect investors after you built your MVP and you don't have any runway, that's a very difficult scenario. And so many founders come to me in that position and they are desperate, and that is not a good place to be. So you will start building your network right from day one, and then you're going to keep that network updated, because the more they are updated, the more emotionally involved they are, and the more they realize that you are a founder that can execute as you're developing that momentum, that velocity that investors are looking for. They say your network is your net worth, but I also add that your network is your company valuation, meaning the better network of investors you have, you possibly get into a FOMO situation, a bidding war, your valuation is going to be better, you're going to get better terms, but also you'll have a network of potential customers, which naturally improves the valuation of your startup. I'll show you how to implement network updates in just a moment. But as mentioned, it's the emotional investment that's so important. We want to see founders go on the journey. We want to see founders face hard times, those challenges, overcome them, demonstrate resilience, learn over time, gain insights, start to iterate and maybe pivot along the way, the more investors know that you're that type of founder that can do those things, the more emotionally invested they're going to be. And ultimately, an investment in a startup, which is a really crazy, risky investment, investors understand you rarely make money. It's an emotional decision. The technical data only supports us wanting to invest in that founder because we're emotionally involved. And as I look back of the checks that I've written as an angel investor or as a general partner working in VC, or I brought deals to the table as a scout, analyst, and associate, there's been an emotional component to it that we can't deny. And you're going to start building that from day one to help you get to the right investor. Now let's jump into the idea validation pitch deck. But before we do, I want to have a conversation with you about something that I see so many founders do. Remember I said, do this before you build anything. But there's something inside founders that just want to build. And I get this temptation all the time. You just want to go out and start doing the solution. Don't do it. It's like the marshmallow test. Just resist the temptation to eat the one marshmallow now so you can have 2 marshmallows tomorrow. If you don't know what the marshmallow test is, go look it up. But you'd rather spend the upfront time building this idea validation pitch deck and talking to potential investors or customers and getting feedback and getting the letdown where you can make quick adjustments to your pitch deck versus building something where adjustments become a lot more costly. On top of which, when you're building things, you get emotionally invested, you start to get cognitive bias. You have the confirmation bias where you're just thinking inside your head, oh, this is going to be the greatest thing since sliced bread. And you get biased from other people saying, oh yeah, we think that's a good idea, or great, good job, keep building. And we hear what we want to hear. If I told you how many startups that I have abandoned right from this stage, idea validation pitch deck stage, you would think I'm a horrible founder and I come up with horrible ideas. But that's the beauty of it. I get to experiment with all different types of ideas and throw it out there into the world and see what catches. And I do this for my venture portfolio. I do this whenever someone comes to me and says, do you want to be a co-founder? Do you want to invest? I say, I'll think about it only if you do an idea validation pitch deck right from the beginning. It's the delayed gratification that I think founders struggle with, but it's so important at this stage. I know you want to jump right in and you probably have the technical ability to do so, but don't end up in the junk pile or the graveyard of all these other MVPs, all these other startups that did not get to funding because they could not figure out product market fit, or the idea wasn't competitive enough, it wasn't an order of magnitude better, it wasn't novel enough, it kind of fell into the mediocre middle and just got lost. Resist that temptation. So heed my words, please try to do this idea validation pitch deck. Now, if you're already starting building an MVP, you can stop. If you already have an MVP, go back before you spend any more time, resources, and make one of these idea validation pitch decks and start from scratch, knowing that you've already got a lot built and potentially you could shortcut if the feedback comes out solid. But that brings us to the last challenge, and that is typically a founder will build a solution looking for a problem. This is when a founder falls in love with their solution, what they're building, more than the problem. Sure, it might solve a problem that you have or a problem that you care about, but if it's not validated in the market, you could build it, put it out there, and nobody cares. And then when you start pitching it, I see founders do this all the time. They try and come up with a problem that somehow fits their solution, and it's totally backwards. If you try and shoehorn a problem because you have a specific type of solution that you think investors want to invest in, you're just going to be basically playing darts, put a blindfold on and throwing it out there until you actually nail it, and that becomes very, very difficult. It's hard because typically what happens is when you get to that problem that you're like, yeah, this is the problem that I want to solve, now your MVP or your solution doesn't quite fit because you've had bits of iteration going on, which then as you go through the life cycle of your startup, 1 degree of separation in the beginning creates an order of magnitude degree of separation in the long run. And you look at your MVP and you say, geez, I wish I would have known this because I would have built it this way or added this feature or not built this other feature and spent half of my budget. I'm going to be a broken record over and over again about solutions looking for problems and making sure that you validate your idea before you build. But like I said, it's not too late if you've already been building. In your idea validation pitch deck, there'll be 9 slides. The first slide is going to be your cover where you're going to have a very simple description. 5 to 6 words, this is what we do. Forget the marketing hype, forget the slogans, forget the taglines. This is what we do. There's the name of your company. If you got a logo, slap it on there. Typically, my idea validation pitch decks are just plain black and white text. So you can get away with this. And I want to get it out there as soon as possible. It doesn't have to look pretty. It just has to communicate what you need it to. The next slide is the problem slide, and your problem is going to be 1 sentence. Why 1 sentence? Well, so you can pitch it to potential customers as well, but you want to boil it down and test that one sentence. And that's going to make you practice what needs to go ultimately into your full pitch deck and not load it up with walls of text that assault the eyes of the investor. Boil down your problem into one sentence, use ChatGPT. It handles it like a total champ. Just say, here's everything I have to do with my problem. Boil it down to one sentence that startup investors want to see. Third slide is a solution. Once again, here's a theme, one sentence. You say, all right, my solution aligns with the problem. It solves the problem with one sentence. If your problem is 10 million people waste $1 billion a year doing something that's slow, manual, and expensive, you say we've built an app or an AI that helps those people do that in a way that's fast, automated, and 90% cheaper. Straightforward, simple. Just make it before, after, problem, solution. As always, easier said than done, but you're going to thank yourself later for putting this practice in when you have to actually present to real investors. The fourth slide is going to be the market, and you're explaining why now. Is there an inflection point? Suddenly, are there like 10 million extra people having this problem, or something changed or occurred? Talk about the market, talk about how many people there are, and talk about what that could be worth to you. You can do a top-down analysis. I complain about this all the time. If it's part of an inflection point, explaining why now, but go and research what bottom up is. I've got tons of videos on my channel explaining how to do a proper market analysis, but you don't have to have the market nailed down. You just have to generally know who you're going to be selling to and how many people there are. The fifth slide is how it works, and that's where you explain what's different. How are you going to solve the problem in a different way for these types of users? What's the magic sauce? And you can't be generic. It has to be novel. If someone you're pitching to says, that's great, but how are you different than this tool that's already out there? You are not explaining what's different. Remember, investors are going to be asking why now, especially if it hasn't worked in the past. They're going to be looking at it going, what's different about this? Which leads us to the team. Why you? Why now? What's different? Why you? That's what slides 4, 5, and 6 are about. And in slide 6, you're going to be answering that. You're going to put your name down there, and you're going to provide some bullet points of your bio of how you worked on the problem, how you have domain expertise, and any other relevant accolades that you have to make you a formidable founder. If you won a Nobel Peace Prize or you have a gold medal in the Olympics, and I've actually partnered and had co-founders who've been in the Olympics, we splash that all over the place because it says something about you, says that you're impressive as an individual, you're exceptional, and therefore you'll do impressive and exceptional things with your startup. The next slide after that is traction, and this is what you'll keep updating. Remember, I said you'll be sending out network updates. The traction will be, hey, here's why I am. You're going to explain the state of the product, user validation, and do you have any growth metrics whatsoever? And just throw that up there and start to update it and continue updating it. So as you show this pitch deck to more and more people, they see the progress. If you have a growth graph, then throw that out there, but traction. And it may be as simple as you've gone out and talked to 10 other potential people who would like to use it. Or you might even say, hey, I've already thought about the wireframe and I have the ability to build it myself. I don't know what it is, but I do know it is an ongoing story, and you will keep updating it because investors want to know. And then you'll put those updates into some type of regular communication. Again, I'm going to show you how to do that in a moment. The 8th slide is a little optional, but this is one of my secret moves. I say not seeking funding at this time. It's optional. Do not seek funding at this time. You are going to add a dynamic to the presentation that you don't want at this stage. Something just happens in an investor's brain. I know this happened for me. A switch goes on when a founder comes and says, hey, I'm going to hit you up for money. Your brain just goes into a weird place. You get defensive or critical, or you don't want to be rude, and so you start saying polite things, and it's not really relevant to the conversation, or you just want to avoid that conversation whatsoever, and therefore you're not going to give any feedback. But if you go and say, hey, your opinion is really important to me, I'd love your advice on how I'm positioning this potential startup that I could raise in the future, I might not, but I don't need funding at this time. Something else happens in an investor's brain where a little tiny seed of potential FOMO and greed sets in, and people start to think, oh, wait a second, they're talking to me now, and they actually execute on this stuff. The idea is pretty good. They might not need my money, and you're going to start playing that game. It's all a game, everyone. Hate the game, not the player. I'm going to show you how to play it to maximum advantage. The last slide is a call to action and your contact info. You're going to say, hey, let's stay in touch. I'd like to send you updates. Or you're going to say, go to our website or sign up for the newsletter, whatever it is. And that might change over time as you continue to add different techniques to get traction for whatever MVP, because you're going to continually be pitching this. And that's one of the secrets, is a call to action will actually create more traction that you can put in your deck to get more traction and more investors interested later on. But most importantly, you're going to ask permission to stay in touch with them and send them updates on how you're doing. And that gets that emotional investment that you're looking for. You're not looking for cash investment right now. It's all about the emotional investment. And when this idea validation pitch deck is done, you are going to get feedback from everybody. And these are potential FFA investors and customers. And when I say everybody, I mean everybody. One technique that I learned from the Chief Marketing Officer, Ryan Rattan at startups.com, is to write down a list of 200 potential people that you could be talking to. And then beside their name, write down why you wouldn't be contacting them. And you're going to be honest with yourself. You may say, I'm scared. And that's not a very valid reason whatsoever, but at least you've identified it. And now you can start to condition yourself to get over the roadblocks that are just going to become that much harder when you're raising real live capital. I've conditioned my friends, family, and associates network to always expect idea validation pitch decks from me, because I've got a network that can introduce me to potential customers, advisors, as well as other investors. But you might not be in the same situation. But understand that FFA goes in a sequence. You have friends, you should have friends, and if you don't have friends, go out and learn how to make friends. You're going to need this skill if you're going to be a startup founder. But every friend has a family member, maybe a rich aunt or uncle, or an associate that could be an angel, which is another way that A stands for angel. Any FFA, friends, family, and associate, that wants to invest in you at this early stage is an angel. But these friends could also introduce you to potential customers. They may say, I know somebody who really needs this. You should go talk to them. I'll set it up. And warm introductions are the best way to do it. Remember, you're seeding your network. You're developing your network now. Your network will be your net worth as well as your startup valuation. And there's this theory out there that you're only 6 degrees separated out from the person that you want to meet. So you don't want to get totally discouraged and say, oh, I only have one friend. Fine. If you have that one friend, start with one friend. I brought certain people to a coffee shop and I said, okay, you're the only person I know in this industry. So you're going to write down 5 names, because I've been a good friend with them. You're going to write 5 names down with people that you're going to introduce me to. Great founders do this to me all the time. They come and they say, can I look through your LinkedIn network and can I ask for certain introductions of people that I want to meet? And I say, great, send me what you want me to tell them. And I'm more than happy to do that because we're already friends. Use your friends to get to family, to get to associates, and all the potential angels out there. Don't worry, you are at the beginning of a journey of 1,000 miles. Trust me, thankless, insufferable miles that you will take one step at a time. So if you're not willing to take that one step and show your idea validation pitch deck to a friend or maybe a family member or an associate and work your way through the list, you are going to find it extremely difficult to raise funding, let alone sell your startup and get customer acquisition going. Because there's something coming up called founder-led sales, not in this video, but I'm going to show you eventually how to use founder-led sales to get your first customers, where everybody's going to be spending money on ads or content and just wasting their time. You're going to beat them to the punch. And that training starts here with this idea validation pitch deck. Now, here are some pro tips. Pitch, but don't raise. We've talked about this. Even if you don't need the money, you may be thinking of bootstrapping. I try and bootstrap all my startups now in my venture portfolio, but I still pitch because it's better to have and not need than to need and not have. You may have a baby unicorn in a rocket ship ready to go parabolic to the moon, and you're going to want that money, and you're going to regret not doing it in the beginning, or not doing the idea validation and customer discovery that's going to help you. So even if you don't need the money, you are going to need customers, and this process will help you get to customers sooner than later. Ask for investment, get advice, but ask for advice, get investment. And you're always going to say to the person, I value your opinion. I need practice. I'd love some feedback. I think it would be tremendously helpful and I'd appreciate it very much. Can I please get your advice? Can I just get some feedback and run it by you? As you get feedback, you're going to iterate and eventually you're going to nail it. But you're going to say, all right, I'd like to keep you updated. If they confirm and validate your startup, you ask them, may I keep you updated? I'm going to put you on my email list. Start building that email list. Don't bug them. Don't be a pest. Believe me, it'll come in handy. That is going to be so important as part of your network, your assets, when you're ready to raise official funding. At the end, you are going to say, who else should I talk to? One more time, the script goes like this. I really value your opinion. Thank you very much. who else of your expertise or your pedigree should I talk to? I want to talk to other people at your quality, at your level of insight, understanding. Say whatever you need to pump up their ego, but there's something in us that wants to reciprocate. It is total human nature. So someone pays me a compliment and says, I know that you know other people as smart as you who are incredibly important and they would have great insight. Who might they be? I start thinking about it because I'm not worried. You've done it so well. You haven't hit me up for money. You're going to be a good referral. You're going to conduct yourself in a way that makes me look good because I'm only as good as my last referral. If they're not willing to give you a referral, most likely you've done something wrong. And that's when you go back to the drawing board and you look back and you say, maybe I shouldn't say this, or did I come on too strong? Did I come in hot with this offer? Am I pitch slapping everybody that I talk to? Do I need to change my executive presence? Do I need to learn some emotional intelligence? Do I need to learn to read the room? Remember, I said feedback is going to come, and this is only going to help you become a better founder. And if you're wondering where to learn this, read this book called The Mom Test. The Mom Test is pretty much the holy Bible when it comes to getting feedback from customers, because it says how to talk to customers and learn if your business is a good idea when everyone is lying to you. They want to lie to you because they want to be polite or other nefarious reasons. And the Mom Test, I can't recommend enough. Go back to basics, read the Mom Test, and most likely it'll blow your mind and point out the mistakes and say, hey, wait a second. How I talk to people while I'm presenting my idea validation pitch deck has been all wrong. And if I make these adjustments, maybe it's not your idea, maybe it's the questions. You've been asking leading questions, you're asking customers or potential investors to predict the future. You're not going to do this using the Mom Test, and everything will go so much better. And not only that, you'll use the same skills later on when you start pitching your product and you're starting to do those founder-led sales. Now take a look at this little chart that I've created. On the left side is market size and the right side is innovation. Market size has to do with how big your market is potentially, meaning how much money you could potentially make. And innovation is how innovative or unique or novel your startup idea needs to be. This has to do with founder funding fit. And I cannot stress enough how discouraged founders get when they go and they talk to the wrong investor, or they don't understand why the investor is rejecting them when it may have nothing to do with your startup whatsoever. It has to do with the investor and their investor thesis. Or founders think that VC, venture capital, is the only type of investment out there, and that's just simply not the case. VC is a very narrow alternative asset class for the world of private equity. And if founders just took a little bit of time to understand how to right size their type of venture to the type of funding that fits them the best, you'll save yourself so much heartache, so many headaches, so much time, all your resources, and just have a better quality of life as a founder. Let's take a look at these axes. If you're going up the market size axis, at the bottom, you're going to have TAM that's in your thousands, meaning that if you took all the potential customers in your market and you multiplied it by how much money you could be making, you could be making hundreds of thousands of dollars. And that's fine for a lot of great companies. You might be building not a unicorn of the traditional sense, but a unicorn, Y-O unicorn, and that could be something that just makes you $400,000, $500,000, $600,000 a year. You're totally happy. And that is a viable startup. And if you want, you can raise investment for that too. But moving up, your TAM is going to be in the millions. That's millions of dollars in potential revenue. And then finally, at the top is billions in revenue. And that's where startups thrive. If your startup is truly world-changing, category-defining, where you're going to be able to make billions of dollars because you have enough people, it's a big enough problem around the world that if all of them paid you, you would be making that much money. And if you make that much money, well, you can give investors that type of return. Now let's look at how innovative your startup has to be along the x-axis. First, you've got 10% better. This is a fantastic way to do a business. Go out there, find a proven business, and deliver it 10% better. 10% better quality, 10% faster, measure it, tell customers, yep, I will give this to you 10% better, even 50% faster, and charge double the price. People will pay for it. That's a great business move. It's not necessarily what startups do, but I want to put that over here in the innovation axis so that you understand that this is a viable option. And there are investors that will participate with you on that level. The next is an order of magnitude, 10x better. It needs to be 10x better than the next closest solution. Maybe there is a solution out there, but you've got a late mover advantage, and now you can do it 10x better than anybody else. That's very viable as well. Maybe there's an alternative way that they're solving the problem, and your way is 10x better. That's a little easier to do, pull off in the marketplace. And then finally, on the right side, when you're in the billions of total addressable market, well, you're probably defining a new category. This is like Uber, Airbnb, all these types of companies that had their first and were creating new types of behavior that people didn't think were possible before. Social media was a new type of behavior. Going all the way back to mobile is a new type of behavior. Going on the internet, putting a credit card online, new type of behavior. Well, that's innovation, and that's also very risky. Therefore, it's totally on the right side of the innovation spectrum. And this diagonal line going up the middle is founder funding fit. You will move up and down that line to determine what funding works best for you. And this process involves 3 factors and how they fit for you. What is the type of capital or the amount of capital that you need? What's the ROI that you want for yourself as well as the investors will want for them? And sometimes those are diametrically opposed conditions or their objectives where the investors are going to want more and you're going to get less, or you're going to want more and the investors aren't going to be down with it because they're going to get less. And sometimes they actually force you to take less or nothing at all, which has happened with some startups that have raised hundreds of millions of dollars. The founders have gotten absolutely nothing. These are the horror stories that I will educate you about. And last are the terms. The terms are the piece of paper that says these are the rules which you will abide if I give you my money. And founders make so many mistakes here. They think it's all about percentage of equity, but it's not. An investor may come in and invest enough to buy 10% equity in your company. Let's say they give you $1 million, and after they put in their money, your post-money valuation is going to be $10 million. They get 10% of the company. Well, that doesn't mean they get 10% voting shares or only have 10% control of the company. They'll make you sign a piece of paper, an operating agreement or an investor agreement with terms saying that, no, before you do anything, you have to get it approved because I'm going to be sitting on the board. Before you spend more money, change strategic directions, hire anybody, whether you pay yourself more money, a bonus because you perform, that all has to run through me. So a minority equity holder could have majority control, and that's where the terms can come to bite you. Later on in CFXO, I will teach you founder investor fit, and I'll explain to you how to look at the different ways you can pick the right investor for you so you don't get hammered and live one of these horror stories. Believe me, I've lived the horror stories myself. Getting back to this chart, let's start right at the bottom, and this is bootstrapping. Bootstrapping is in the bottom left because if you bootstrap, it doesn't matter what your market size is. You can have a small market and make a few $100,000 a year and you'll be fine. You don't need investors. And you don't have to be as innovative. You can say, I'm just going to do this thing that's going to be a little bit better than the competition, make my money and invest in other things. That's fine. Therefore, bootstrapping has the lowest entry point, lowest barrier of entry when it comes to market size and innovation. And as expected, on the top end, you've got venture capital. Venture capitalists are going to want the most market size and the most innovation. And that's why so many founders get rejected by VC because the investor says, we don't see how you're going to 50x our capital, you're going to give us that level of return, or we don't see how you are 50x better or category defining in the marketplace when there are all these other competitors. Now, I mentioned private equity before, and I'm going to put it sort of right here on the lower end of the innovation axis, but on the top side of the market. The market size is important for private equity because they want to be making as much money as possible. Most likely, they're putting you in a portfolio and they want to make sure that they're protecting their market share and that you can service as many people as possible and make a lot of money. But private equity, in my experience, doesn't push innovation the same way that venture capital does. Private equity, they're okay with really boring businesses. If you've got a competitive advantage, you've built defensibility in a big market and you're holding strong there, private equity will come and do business with you. The problem is private equity doesn't participate in early stages. Private equity will come to you after you've established that market size. And let's say you're doing $10 million a year in your SaaS. Private equity will come sniffing around. But in the meantime, I don't think private equity is a viable option unless you've got some inside connection. Let's go back and start in the bottom left. Your next one is going to be friends and family. It's kind of like bootstrapping, but their demands aren't as big as VC. They're not going to need as big of a market or for you to be as innovative, but you need a bigger market because you're going to have to pay them back the returns, so you need to be able to make more money. And you need to be a little more innovative so that they say, oh, this does make sense. It is different. It needs to sort of light up their imagination, their world of possibilities. So adding in more innovation will help you convert friends and family. Then you've got personal loans. Personal loans are higher in market size because you have to pay back the loan. And the loan officer at the bank, they're going to be analyzing this. Whenever I work with money that comes from banking in some form, they're always big on market analysis. but they're not as big on innovation. Banks are fundamentally risk averse. So if you tell them I got this new category defining thing or this disruptive piece of technology, they're going to say, prove it first. Proving the market out is more important. Therefore, it's a little further back on the innovation than friends and family, but personal loans are extremely viable. It's a potential add-on. You can combine it with friends and family, which is a great way to sort of bootstrap your startup and not use institutional capital. So this trifecta of bootstrapping, friends and family, and personal loans, yeah, that's a winner in my book. Moving along, we have bank and SBA loans. These are loans that are not collateralized by personal property or assets. Banks try to make it look like, oh yeah, we're making it so easy for you to get money from us. It's not easy whatsoever. They need years of operating history. They need to understand your P&L. Just all these conditions have to apply. Your credit score has to be good too personally. And sometimes they say part of it you have to back personally. You have to give a personal guarantee. You don't have to necessarily put up your house, but you have to say, I'm willing to put up my house. But what I do like about banks and the SBA is that they're a little more interested in innovation than if you're getting a personal loan or you're just trying to go out and get a credit card. They're more in line with the market in terms of progressing it along, because if they could be funding something that turns into a unicorn, well, it just looks good for them, as well as they've got stakeholders, shareholders that mandate that we need to get into new markets. We need to try new different things, because the banking industry is just a complete monster and they have to be spreading out their capital, diversifying their risk so that they can generate that money. And they're trying all different things. So I find that they're willing to take a little bit more of a risk than if you're going and getting a personal loan. Close to that are your revenue-based financing. This has become more popular than ever. If you've got something innovative, and let's say you're doing a new form of e-commerce or online digital distribution, and you're generating the revenue, it doesn't even have to be a lot of revenue. You can get revenue-based financing, and you can create an ongoing line of credit. I've accessed these before, especially in a pinch. They can come quite in handy. I've developed my reputation with PayPal and selling digital goods, and PayPal offers me revenue-based financing all the time. They say, wow, looks like you had a really great quarter. We're going to offer you this amount of money on a credit card, or we'll just factor something in and say, all right, we'll prepay for this invoice, knowing that you're going to get paid 9 days later and you have that track record. The challenge with revenue-based financing is it's designed to be short-term. Therefore, interest is really high, so use with caution. This brings us to the angels and micro VC. Micro VC are typically founders who've exited and they act like angels, but they're structured like VC. It's kind of like a gray zone where these founders are more generous with the capital. They understand what it's like to be in your shoes, so they act like angels, but they also have worked with VC and they understand the parameters and they do want a pretty nice exit. You are in the upper half of innovation and market size necessary, because a lot of these angels and micro VC want to see you go and eventually raise from VC. Therefore, you're going to have to play that game. But also, angels and micro VC don't have the limited partners. They don't have investors for their investments that they invest in you, so that you don't have the same types of requirements to return their capital, especially if that's as far as you go. But they might want you to move ahead into the next round. Let's say invest in pre-seed or they invest in your seed. They want to go to an A round. Therefore, they're going to need more innovation, more market size, but not necessarily the same. And that's why I'm putting them kind of in the upper middle of the pack, which then brings us to accelerators. These are your Y Combinators, your Techstars, your A16Z Speedrun, and they're right between angels and VC. Accelerators need you to go to VC. That's the reason they touch that bubble. But also, a lot of angels and micro VCs participate in accelerators as well, can help you get in. They act as mentors and they provide money as partners to these accelerators all the time. You look at the way that YC is structured, you got a whole bunch of founders that are acting like micro VCs, partnering with Y Combinator, but eventually their exit needs you to go to VC. So that's why you need to demonstrate market size and innovation, and they'll help you move further along. But the standards are pretty high because there's so much competition trying to get in there. While YC is a program where they invest in you and they give you $500,000, at least that's what I saw the last time. There are accelerators that you don't have to pay. They just give it to you for free. They're probably run by a state, or they're sponsored by some wealthy individuals. Or there are accelerators that you can pay to get into and you don't have to dilute your company. You don't have to give away any capital. And that's just the righteous value exchange. What you don't want to do is go to an accelerator where you have to pay them large amounts of money and then they take out large amounts of equity, maybe in in warrants or safes on your company, that's not a good idea. I've seen many horror stories. A lot of our competitors at startups.com had that type of model, and they no longer exist because it can get pretty predatory and the outcomes just haven't been proven. Now, let's add a couple more alternative options. Rewards crowdfunding is a great way to fund your startup. If you're doing something really cool and innovative, you don't even need a big market. You can get 1,000 people to give you $100 each for your product, and you've raised $100,000 to build your product. A lot of great companies have been funded that way. One of the early ones was Pebble Watches. They started right on Kickstarter, and they completely funded and launched products through Kickstarter. And then eventually they showed product market fit through that methodology, and they got other investors involved. I've done this myself, where I've done a crowdfunding campaign based on rewards, and I went out and sold $45,000 of product. Then I showed that to investors, and they put in another couple of $100,000. As I said, the benefit here is you don't need a huge market to pull this off correctly, but you do have to be a bit more innovative, which brings us to the next type of crowdfunding. That's equity crowdfunding. And here it's a little more stringent. You have to have big market size because you're going to have to pay back the investment, and you want that market size where you're going to attract a diversity, a large group of potential investors, which might be your customers. But if you want them to put in $100, $500 a piece in, the bigger the market size that you have, the more money you're going to be able to raise. And the innovation is pretty much the same. They're looking for the same uniqueness because they want to get rich like other VCs. They want to act like individual accelerators. Like these crowdfunding sites, WeFunder, Start Engine, they're pretty much equity-based accelerators that use crowdfunding to help you accelerate. And you meet a lot of angels doing equity crowdfunding. And you might want to use a technique of funding in public, which I talk about on my channel. I recently put out a video, and I know people who are doing this, and they're doing extremely well by going out and building things in public, as well as keeping investors informed in public. And the people in that public market are coming in, and they are acting as amazing angel investors, and they avoid VC altogether. Last one I want to talk about is grants and competition. You'd be surprised to how much money is available out in the market in the form of grants and prizes in competition. Nonprofit organizations or government organizations earmark money all the time for things that are innovative. So they want to push a specific industry along. Let's say you've got a state that really wants to get into a certain type of technology. They're going to play the long game. They don't have the same requirements of return as an investor. They want to see you start and get an industry going. I have a startup in my portfolio right now that is specifically funded by grants. Entrepreneurial grants and a competition that says, hey, we're just going to give you $15,000, $30,000, then give you another $100,000 just to explore and improve the viability. These startups are getting paid to try and prove the viability, trying to think of an MVP. They're getting paid to do that. They're getting investment, and they don't have to pay it back. What they do have to do is participate in the parameters in which helps the innovation of that program. That objective move further along. According to the state or the stakeholders, whoever's funding it, they're going to want to know that you're moving the needle, you're advancing their agenda. And that's why the market size doesn't even have to be that big. A lot of them are local, and they say just as long as you service this local area and you make enough money to contribute to the local economy, we're good. You don't have to go global. It'd be nice, but you don't have to. And they're all your options when it comes to founder funding fit. What I want you to do is write down all the options and research them. You're going to thank yourself later. I hope you thank me later for this, and open your eyes to the world of possibilities out there. And part of this process is to really rely on your self-awareness and ask yourself, does this type of funding fit me? Because as I'm going to show you in just a moment, it is going to affect the way that you pitch. Let me show you the factors that will help you make this decision. On the lower end of the spectrum, in founder funding fit, you're going to get less capital. There's less capital available. You'll only be able to access a certain amount of money for personal loans. Most likely your family only has a certain amount of dry powder that they're going to invest in you. Unless, of course, you're part of a rich family in which you're probably not even watching this video. You don't have these problems. But less capital means that the market is going to require less ROI. A lot of investors at this level are okay with a 15% royalty or a 15% annuity. Maybe if they double their capital over the next couple years, they're okay with it because they don't have the same types of LPs breathing down their neck. Maybe they're just saying, we want to see you successful and pay us back. You don't have to pay us back with any interest whatsoever. That happens a lot at this level. So the market requires less ROI, and that's something your startup might be better suited for because you're not one of these world-changing unicorns. You're just going to make a healthy dose of money and pay people back. You also get better terms according to what you want. Your terms can dictate the type of investment because these investors are not sophisticated. I'm not saying they're cavemen. I'm not saying they're dumb. I'm saying that they're not used to the same game that VCs are. And so you're not going to get crushed by terms. You can say, hey, I'll pay you back 15%, or I'll pay you back this amount, take it or leave it. And that's fine, especially if you're already generating that revenue, you got that traction where it's attractive to them. It's all a trade-off and a balancing act. The less capital you take in, most likely the less ROI that you're required to give back to the market. And then your terms are going to be the primary dictator of how the deal gets done. And you're going to like those terms because they're yours. As you can guess, moving up, you get access to more capital. VC accelerators, you want to get into YC, they give you a pretty large sum of capital to begin with. VCs can stroke those $1 million checks. They've got the funds. They've got $100 million, $200 million in the war chest. The dry powder sitting around, and it's always going to be around. You've got access to more capital, but that means more ROI. They are going to require you to give them a 50x ROI. Can you take $1 million and turn it into $100 million? They need you to be able to do that, not just a founder, but can your idea support that type of ROI that's required by their funds? Because remember, they just don't have to pay themselves back, make their own money. They have to pay back their LPs. And if 90% of startups are failing, there's going to be a lot of portfolios. 9 out of 10 are going to fail. Therefore, the one that does hit needs to go unicorn to pay back the entire fund. And that's how these VCs work. And of course, the more money you take in, the more terms that you are going to have to contend with. They are going to stuff your term sheet with terms and tell you what you can or cannot do, what you have to be doing, and if you don't, what happens, such as liquidation rights if things go bad, drag along if they sell, pro rata, super pro rata if you want to go and raise more money, how much money that you get to take off the table. They will determine all of that, but you are working with venture capital and you have the chance to raise gads of money from VC. Let's summarize how the funding that fits you will change your pitch. Your minimum market size is going to change. How much you could potentially make, that is completely going to change. If you can potentially make millions, that's okay for a certain type of investor, but remember, VC need to see you in the billions. The degree of innovation, how much different are you out there compared to the competitors or the alternative ways people are solving the problem? If you have technical innovation, you're going to have to be very technical, and that's going to have to be in your pitch deck, part of your team. Show that you can technically build something. If not, you don't need to be as innovative. Well, guess what? All bets are off. You have easier access because you can use the tools out there right now without having to build anything. The size of validation network has to change. How many people are in your network? Founder market fit. How many people you've talked to? How many potential customers are in your network? That is going to have to change. You're going to have to explain how much idea validation. If you're building a B2C app that needs to go unicorn because you want VC funding, where you're going to have access to tens of thousands of users right away to move the needle and have them go, oh, this is viable. You can't go in and say, hey, my best friends would use my app. That's not going to work. But let's say you're doing a pool cleaning service and you're just going to make enough money to service your local area. Well, all you need is validation from your local area that you need pool cleaning. Maybe there isn't enough competition. Or maybe you've talked to 10 pool owners that say, yeah, I'm going to let you clean my pool and I'm going to pay you every month for it. But all of the above will change by orders of magnitude depending on the type of funding that's going to fit you. Just to hammer this home, being better by 10% is not good enough in the world of institutional capital. It's fine in the world of small business. It's fine in the world of friends, family, and associate investors, institutional loans with banking, personal loans, especially if you got credit or you've got assets. I own businesses in my portfolio that are growing 10% year over year, and that's just fine with me. I'm not pushing them to be innovative or to go out into new markets or build technology that's blowing people away. But so many founders only reach for 10% improvement and they go talk to investors or they try and play in the sphere where 10x is the minimum barrier of entry. It's table stakes. If you're not 10x better or above, then you're not going to make it in the startup world, and you have to be realistic about that. The problem is social media and this whole industry of gurus try to sell you this bill of goods. They try and scam you and convince you that you can go out and access that type of capital. You can go out and play in that world if you just use their templates or their tools. It doesn't happen. Founders that create unicorn companies are exceptional. They can do things 10x better by an order of magnitude better than everybody else. That's the way they think. They have those insights. They're contrarian. While everybody's trying to one-up each other 10% of the time, these founders are blowing everybody away. And I've talked to these founders and they run circles around me in terms of their 10, 20, 30, 50x thinking. But if that's not you, that's okay. I fully confess these days, I'm pretty much a 10% founder. I like to do things 10% incrementally at a time. I'm on the back nine of my career where in the beginning I was chasing unicorns, trying to do 10x everything. I'm only doing 10% at a time, and I'm fine with it. And you should be too. If that's the world you want to live in, build a YO unicorn that fits you the best. Take a look at these slides and just imagine for a moment how they change depending on who you're pitching, what type of funding that you need. A problem that you're willing to bootstrap is fundamentally different than the problem you have to solve if you're looking for VC money. And not only that, the quality of language, the vocabulary, the way that you communicate has to change. If you brought me one of these decks and you said, I'm only pitching friends and family, I wouldn't care as much about you using certain types of terms and jargon. Maybe buzz and hype words work with friends and family, but they're not going to work with VCs. That's why I always ask who is the audience for your pitch deck before giving you feedback, because if you just said, no, I'm just going for a personal loan or I have to submit it to a bank, well, I'm going to say, well, then I don't have to worry about it as much. Let's just fix some fundamentals. But if you said I'm pitching A16Z or I'm going to go to Sequoia, I'm going to pitch Mark Andreessen, then I'm going to say, you know what? We need to change a lot of this and really refine it and practice, practice, practice. And don't ignore the feedback. That's going to help you understand founder funding fit. Get feedback from everybody. Practice with everybody. Don't think anybody's beneath you at this stage, but also don't think you're beneath anybody else. Get out there, try it, give it a go, see what they say, and you're going to be so much better equipped for the rest of this journey. Speaking of which, make sure that you join CFXO for free downloads. You can follow along. I put all the materials out there for you, and watch the other videos that I put on the screen. I'm creating playlists where you can go through CFXO. You can start learning from step one. I'll also put together playlists that are relevant for different stages of CFXO, so we get a wide range of advice, perspectives, and techniques that you can use. As always, let me know how it's going. I appreciate your feedback. Let me know. Thanks for spending time with me here on this video. I'll see you in the next one.